So the pre-approval letter is good for 60 days. I like to tell people your pre-approval letter is good for as long as nothing changes. We might have to update income documents, but as long as you're not having your credit pulled a ton, didn't go out and buy that new Ferrari, the debt to income ratios haven't changed, not charging up a credit card, the pre-approval is going to be good, continuing making on-time payments. So as long as score maintains the same and debt to income ratios stay the same, it's going to be good. But the pre-approval letter is good for 60 days. So mortgage insurance is typically applied to many of the government-backed loans. So FHA, VA does not have a mortgage insurance on it, right? FHA does have a mortgage insurance. FHA is a standardized mortgage insurance. So regardless of your credit score, it's just based off of the amount that you're putting down. At 5% down, it decreases. Anything above 5%, it's at a certain amount. On conventional, typically, anything with less than 20% down will carry mortgage insurance. For the most part, anything less than 20% down would be a situation where there's mortgage insurance. Now, on those conventional loans, it is individual, so it's based off of your credit score. It's based off of what your debt to income ratios are, what your loan to value is, how much you're putting down. And so that can vary on conventional from person to person. Let me explain what a debt to income ratio is, because that can be confusing to people. There's two sides to it. There's a front end ratio and then a back end ratio. Your front end ratio is all of the housing expense and what you're pre-approved for. So that's the loan amount, the principal and interest, the property taxes, the homeowner's insurance, any HOA fees that would be associated. That gives you a front end ratio. And then that plus whatever's on your credit report, auto, credit cards, whatever, that's the two of them combined is your back end ratio. So the pre-approval is really based off of your debt to income ratio. So if you have a house at $400,000 you're pre-approved for, but one has $4,000 annual in taxes and one has $7,000, that pre-approval might shift. So you might not be pre-approved for $400,000 on that one with the higher taxes. That's why it's so important that we keep that open communication throughout the shopping process of like, hey, we want to go look at this house and make sure we're good, and we'll give a good idea to the agents. Usually we can tell them, hey, this is the max payment that we can get to, and they can use just little payment calculators to say, hey, this should work. But in the end of the day, it's important that we're in communication with both the borrower and the agent throughout the process. It just boils down to fitting in the DTI, right? In the debt to income ratio. And your payment sensitivity. What's your payment comfort level, right? That $4,000, that $10,000 difference is $800 a month, right? It's a $800 and some change. It's a big swing. And so it boils down to the borrower's comfortability with the payment and making sure it fits within the allowable debt to income ratios. So it is important, and we try to do our due diligence up front so that you're well informed going into the process. I hate when people are standing in that living room and they fall in love with the house, and then it's just something that's not achievable for them. That's why we want to keep the communication open up front.
Give us a call. We'd love to answer any questions you have.